The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everybody, and good evening to my guest, Anand Bhatapati from GFM Focus Investing, who has got up for us in the middle of the night to present from Hong Kong. Anand is the portfolio manager at GFM Focus Investing. I'm going to hand the microphone over to Anand in a moment. He's going to be talking about, his topic is do great companies make great investments. But first of all, I just want to direct your eyes to the IBKR disclosures on the screen. Just please take a moment to read those while I go through a couple of other items of housekeeping. Today's event's being recorded, and you will receive a link a couple of hours after the end of today's event. So look out in your inbox for a link to that recording, and I think we can forward to the next slide in preparation for meeting Anand. What else did I want to ask you? If you have questions, please put them into the question panel in the GoToWebinar pane there as part of your software there. And Anand does a great job of answering those throughout or at the end of the session. So please keep your questions coming in for him. And if he doesn't get to any of your questions during the event, I'm going to follow up with him with a spreadsheet of all the questions from all attendees, and he will definitely reach out to you. So Anand, do great companies make great investments? I'm going to go on mute and let you tell us the answer. Welcome, Anand.
Thank you, Andrew. Appreciate a wonderful introduction. So also, good afternoon, good evening to everybody who joined. I think there are some familiar names here, but also a lot of new people. So welcome one and all. It's my pleasure to be here. And the answer to this question is basically something that we learned with a lot of sweat, blood, and tears over 20 years of investing in capital markets experience. And I'll try to share it with you. Hopefully, the idea is to give you a framework that will make you more successful in following these principles and becoming better investors in your careers down the line. So with that, I also have a couple of legal notices that I'm asked to put up. First of all, we are a regulated and licensed investment management firm. We're regulated by the SFC in Hong Kong, FCA in Europe, and SEC in the US. And this firm, GFM, is not affiliated to any financial institution, and we're not affiliated with Interactive Brokers. We do work very closely with them, but we're an independent investment management firm. This presentation is for educational purposes only. Please do not take anything that you hear over here as a recommendation to buy or sell any asset, or please do not consider this to be any kind of a solicitation. So that being said, I will continue. So this is my background. I have some 23 years of experience in New York, London, and Hong Kong. Essentially, I was in the US. After I set up and sold a tech company, I was a venture capitalist. Then I rebooted my career and I became a derivatives trader in London and Hong Kong. And a few years ago, I set up GFM along with a friend and colleague of mine, Tariq Dennison. Tariq and I knew each other from 2004 when we first met at Bear Stearns, and we've essentially been working together since that time. That's my background. GFM, this is the company we set up. Well, basically we set it up because we couldn't find anybody who would manage money on the way that we wanted it to be done. So we are very, very different from all kinds of ETFs, hedge funds, and mutual funds. And these are some of the features of why we are very different. Every client's account is held in a separate account in their own name, not in a commingled fund, at a third-party financial institution like Interactive Brokers. We are performance fee only, and the fee gets triggered if the portfolio exceeds the previous highest level. So we only make money when our clients make money, and that money gets made and kept made. We are co-investors alongside our own clients, and my own portfolio, my own bulk of my savings is in exactly the same investments as that of my clients. and statements, custody, fee calculations, all these are done independently by the financial institution where the account is held. So there's independent oversight. If you like, you can please visit our website and find out more about us. The point I'd like to make is we are not a fee collecting fund manager, but we are more like a investment partnership. We have exactly the same incentives as our clients, and we think and operate like then a partnership alongside our clients. So that's us, the firm, that's my background. And so let's dive into the questions. Do great companies make great investments? So to answer this question and kind of get a real sense of it, I would like you to imagine that you have $100,000 in your pocket that you want to invest, and we take a time machine and a ride back to the 1990s. So 1990s was remarkable because there was a once in a lifetime phenomena that has shaped the world ever since, the birth of the internet. So internet started in late 80s, early 90s, and by 1995, there were only some 15 million odd people online. And by the end of 2000, that was something like 360 million people, roughly 1.5 times the population of the United States. So this was small in the scheme of things compared to the overall world population, but that growth of the internet and the popularity and the impact it had was life-changing in many ways. Email started replacing faxes and physical mail. The magazines and newspaper business changed beyond recognition. E-commerce in the form of eBay, Amazon, and so on started becoming widespread. Credit card online payments started first appearing, and that has led to so many innovations down the line and a new wave of fintech these days. So I'd like you to think about the era. It was a very exciting time, and the optimism was palpable. Like I said, I was a venture capitalist in the US, in California and New York at the time, and not a day went by without the possibility of creating something that was truly remarkable not appear in front of your eyes when we heard all these business plans and so on. So just to give you a sense of the excitement and the optimism and the possibilities that was there, I'm going to play a short video and then we'll continue. This was the mid-90s, and Netscape was the first internet portal. And then Yahoo became very popular. America Online was the dominant internet provider and portal at the time. Then there was a lot of change, a lot of excitement, a lot of competition. GeoCities came out of nowhere. And as you'll see in the next few seconds, there was a lot of changes. MSN, Microsoft, they went after Netscape and basically put it out of business. And MSN started coming up. America Online grew and grew and grew. And this was the power it created in the market that they basically took over Time Warner at the time. If anybody goes back and remembers that era, maybe some of you were students, maybe some of you had joined the workforce, but the birth of the internet made computers permanent fixtures in offices and universities, at homes. Desktops and laptops became ubiquitous, and the internet started having a very deep impact. Amazon found its feet around this time in the late 90s. noticed that Google was not even on the scene. So with that as the background, let's first dive into this question. What do great companies make great investments? So like I said, internet was everywhere. It entered Silicon Valley, became a household lexicon term, and anything tech was getting an enormous, never seen before lease of life. So in that background, imagine that you have $100,000 to invest and you're in this era. So what you can see is that the internet was taking off and it was impacting people's lives. And like I pointed out, in the mid-90s, there were only 15 million people, and that went to something like 360 million people by the end of the 90s. That was a growth which was really, really stupendous. So the company I want to talk about is Cisco Systems. It's a very technically savvy company that was started by two Stanford computer scientists. They basically made hardware equipment known as blue boxes that connected computers to the internet and managed traffic. So it basically what allowed people to get online and manage their life on the internet, whatever it is that they wanted to do. So it started in 1984. They shipped their first commercial product in 1986. It was wildly successful. And 4 years later, in 1990, they went IPO, got listed, and it started life as a public company with a market cap of over $200 million. And like I said, it was extremely successful. And by the end of the 90s, it had operations and market share in 75 countries, and it was dominating its space. And this slide shows you how successful they were. In the 10-year period that they were a public company, their revenues went up 10,000 times. And in comparison, S&P 500 revenues basically went up maybe 100% in that decade, approximately. So this was a wildly successful company. And moreover, this was not hype. This was not some .com. This was not pets.com that didn't have anything other than popularity, hype, and eyeballs. It was a real business with real earnings, and even those earnings went up 6,000% in 10 years that you see in the first 10 years of its life as a public company. Moreover, the profitability was just enormous. Cisco's return on equity, the most comprehensive measure of profitability that you can look at from a shareholder's perspective. ROE for Cisco was 3 times that of rest of corporate America. You can see the red line, which was corporate America, which is about 12-15%, which is more or less a long-term average for indices like S&P 500 or so on. Cisco was about 3 times, 2 times on average higher than them in this period of time. So it was an extremely profitable business. The tailwind was firmly behind them. Internet explosion was everywhere, and they had a dominant position in their market. And if you break down the return on equity, you could see that it was very healthy. In fact, I would refer you to my previous webinar where we did look at what a good business looks like, and we went quite a bit deep into things like return on equity and how to judge the quality of a business and so on. So I'd refer you to that webinar, but suffice to say that Cisco was a phenomenon. Its growth was off the charts. Again, you can see this compared to the rest of corporate America, S&P 500 in this case. And all this earnings was of very high quality. They were banking at least $1 or more than $1 of accounting earnings in the bank as cash. So when you see conversion of earnings into cash at such high rates of 100% or higher, that points out that the quality of underlying earnings are very, very good. This is the first measure of earnings quality anybody would look at. So to summarize, this is a slide from my previous webinar. Cisco was a compounder. It was a special business and it had a dominant position in the market. It had a very high and stable return on equity that suggests that it was a special business. It was reinvesting heavily to support the growth that it was seeing. And the reinvestments, the fresh investments, were also highly profitable. That was manifesting itself as revenue growth, earnings growth, cash conversion. And like I said, the cash that was generated by the business was being used back to reinvest into the business and fuel further growth. This is the anatomy of a compounder. And again, like I alluded, you could please take a look at the previous webinar I did, which breaks down what a compounder looks like and why these are such good businesses. Okay, so fine. Cisco was an exceptional business. We've seen the evidence. And you're in 1999. You have $100,000 to invest. Was Cisco also a good investment in, say, 1999? What would have happened had you put your $100,000 into Cisco stock at the end of 1999? What you'd have seen before you made the investment was the company was highly successful, exceptionally fast growing, and of a very high quality and a dominant position in its business. And the stock market had recognized this, and its stock was appreciating, as you can see in this chart, in a very rapid fashion. The chart in 99 would look like this, and today it also looks like the charts of quite a few companies, like Tesla, for example, or Peloton, or Zscaler, or a whole pile of other companies. So we'll come back to that point. So the stock market recognized its success, and the stock was growing very fast, and all the investors prior to 99 seem to have made a lot of money. So you're at the end of 99, you got $100,000, and the investment case would have been something in the order of, the internet is only 360 million people. That's something like 6% of the world population. Internet was beginning to find a lot of growth and acceptance in places like Europe, Japan, Southeast Asia. Places like China and India were not even on the map at the moment. So you could see a lot of growth. And here there was a company that was dominating its space and was very well run and highly profitable and successful. So would this be a good investment? Chances are, if you had thought along these lines, it would be hard to argue otherwise. It was possibly a good investment. So let's say you put your $100,000 in Cisco in 99. After considering all this, what would have happened? Here's the shocking result. Initially, you'd have made a little bit of money. You'd have made 50%. And then you would have lost half your money, and your money would have stayed underwater for a good 10 years, the green line. It's a shocking result. So let's say you say, okay, you're an investor, a long-term oriented person. Maybe this 10 years was bad, but let's see what would happen. And you held on for 20 years. In 20 years, your investment, you would have lost half your money and you would have never recovered. Meanwhile, the stock market in the red line, somewhere after the first 10 years, started doing back well again, and essentially more than doubled your money as an alternative. So even if you were a long-term investor, even if you're patient, you would have lost an enormous amount of money. That is a shocking result. So somebody in the audience is probably thinking, hey, this guy just gamed the whole thing. You know, we all know that there was a bubble, a stock market bubble in 1999. So he just picked the worst possible time. So let's see what would have happened if you had invested after the bubble burst. The bubble burst in something like March, April of 1999. So let's say you had invested at the end of the year 2000. So what would have happened then? you would have seen a chart like this, and you would have said, hey, look, the stock went from a peak of something like 550 billion valuation to something like 250 billion in valuation. It's down by half. It's at a 52-week low. It's at a multi-year low, actually. So again, the underlying fundamentals are good. You know, the internet is growing, this company is dominant, it's profitable, it's fast growing, it's run well, etc. So maybe buying it at half the price would not be such a bad idea. So had you bought at the end of 2000, what would have happened? Your 100,000 would have also suffered a 50% loss permanently after 10 years. You would not have recovered anything, anywhere close to your initial mark. And if you are 20 years later, you would have still seen losses, big losses, if not 50%, maybe a 30% loss. But meanwhile, the stock market not only recovered, went on to nearly triple your money had you chosen the stock market instead. So again, this is a shocking result. This was an investment made after the internet bubble had burst. So here's the full history. Whether you had invested here in 99 or whether you had invested here in 2000, you would have invested basically anywhere here. You would have either had mediocre results or you would have lost money. One of the two things would have happened. So let's think about that for a second. What went wrong? Was Cisco a bad investment that, that was just unlucky? Did something happen to the business that made it a poor investment after 99 and 2000? So the people who went in at that point in time, they suffered because the business worsened. Did the business deteriorate? Well, the logic in 99, 2000 would have been right. Internet usage took off. And in the 20 years following the year 2000, internet usage globally went up 8 times, 8,000 something percent. Today, there are 5.5, 6 billion people online. All of, big chunk of China, big chunk of India, all of Western Europe, Japan, North America, and a lot of emerging markets in Latin America, Africa, and so on. They're either online or heavily coming online. So you would have been right that the internet was a phenomenon and not a fad in the pan. And so the addressable market for Cisco did expand exponentially. And the company itself did quite well. Look at the revenues. When in the year 2000, they were making something like 19 billion in revenues. And today, they're clocking close to 3 times higher, close to 50 billion revenues. Look at earnings. They were only making 2.73, under $3 billion in earnings. And today, that's up some 6 times to close to 12 billion. You can see that here. And the earnings quality remained pretty good, as you can see. Profitability did go down from very high levels to medium levels to okay levels. This is essentially the profitability of, say, corporate America, S&P 500 or Euro Stocks or MSCI World. About 15%, 13, 15% return on equity is what you'd find for most of the companies on average. So Cisco was still profitable, but not as profitable as it was in its early years. What happened was growth dropped, first from the near 100% a year to a middle leg where they were growing at 25, 30%. And then these days, they're hardly growing, close to 0%. Well, that kind of makes sense, right? The world already has 5.5 billion people online, and all these computers are already networked and they're connected to the internet. So it's kind of hard to find the levels of fresh growth in the form of markets and clients in order to sell the stuff. So as you can see the summary in this chart, revenues went up some 3%, earnings went up some six times, revenues went up some 3 times, earnings went up 6 times. Profitability dropped from the 30s to 15s, mid-teens, and revenue growth and earnings growth are sort of now index-like. So this is what happened. The company did not deteriorate. In fact, it grew. As it grew, it became mature. And the signs of maturity are lower growth and less than abnormal profitability. This is what you see over here. But in the end, it was a successful business. But if the business did well and the people who looked at the business and the internet growth said this was a business with a bright future, they were right. Why? But why did the investment lose money? Let's look at that angle for a minute. So let's go back to 1999-2000, and I'll take this in the year 2000. What you saw in the year 1999-2000 was the business was doing very well, and earnings was also doing very well. But as the earnings were doing well, the stock market suddenly became hyper excited about this business, and you can see all these valuations just went exponential. At this valuation of some 236 times, Cisco was literally the most valuable company on the planet at the time. So valuations were very, very high, and let's take one of the valuation ratios, price to earnings. So before 98, it was still an expensive company at like 50 times earnings, 45 times earnings, 25 times earnings, whatever. But after 1998, the earnings multiples just went 100, 150, 236, back to 100 something, and so on. So the valuations were extremely optimistic. And compared to the index, this is the index, the red line. At the end of 2000, it was trading at around 37 times, which was considered expensive. The average for this whole period was about 27 times. And Cisco, as you can see, was much more expensive on a valuation basis. So here's one way to look at the valuation. So let's say you have to say that at some point, Cisco is going to be a successful but a mature business. And when it's a mature business, it will trade close to stock market averages. So let's say we both agree, for argument's sake, at some point, it will trade like the stock market, so therefore something like 25 times earnings. So what if you were to pay this and expect to then see valuations sometime in the future of 27, then essentially earnings have to go up a lot to compensate, right? So let me restate that again. If in the year 1999, you were to consider that this would be a good investment, and when it's a mature business and successful and big, it will trade sort of like the stock market. Essentially, you're saying it will trade at something like 25 times earnings sometime in the future. So if you're buying at 236 times earnings in 99, and later you expect this to happen, how much is the embedded growth in earnings that this is projecting, embedding? So essentially, if you think at some point in the future, it is going to trade at 26 times, then you're expecting that this number here will go up, earnings will go up from something like 2.5 billion to something like 18 billion. This was at peak valuations. And if you're saying it will go up from this to earnings will be much bigger, you're expecting earnings to be in this range. So essentially, whether you took the peak valuations or whether you took the end of 2000 valuations, the stock market was basically saying that this will grow to here or here in some time in the future. So let's see what actually happened. Well, the stock market was projecting a growth of earnings that looked like that. So they probably thought in 4 or 5 years, the company is going to hit something like 7-8 billion revenue in earnings. Actually, that took a much longer time. It only, seriously crossed this yellow line some 13 years after 2000, not 4 or 5 years after 2000. So these estimates were very optimistic back in 99, 2000. And this was so optimistic that even after 20 years, earnings are not even come close to this level of earnings expectations. So therefore, what happened was a lot of earnings disappointment as growth decelerated. And as growth decelerated, valuation multiples started coming down. I mean, please ignore these spikes and funky numbers because data is bad. My point is, as the stock market started realizing that earnings growth is not going to be as optimistic as they were expecting in this period of time, valuations started coming down. And despite the fact that the company was posting higher earnings, higher revenues, higher cash flow, the downward pressure on multiples were so great that the market cap just could not overcome this fall in earnings, even as the earnings themselves were going up. So earnings went up, but the market price paid for these earnings started falling pretty heavily. So essentially what happened was the stock, which is earnings times the multiple the stock market awards, as the pressure, the downward pressure on multiples continued, the market cap fell. So had you bought it here, had you bought it here, had you bought it here, you would have just seen either terrible or mediocre results. This is basically what happened. This was a great company, but it was a terrible investment. And now to generalize a bit, let's take a look at a few other companies which were also fantastic businesses. Coca-Cola. This is a chart that goes back some 40 years, from the 1980s to 2020 and 2021. This is an investment that made Warren Buffett's reputation. At this point in time, in the early 1980s, Coca-Cola went from being a conglomerate that was in a number of different unrelated businesses to being a focused non-alcoholic beverages business, and it started getting its act together. And this was around the time when Buffett put about 45% of his capital in Coca-Cola, and he still holds it. And essentially, had you put in $1 million in 10 years, that would have been worth 10 times $10 million. And that $10 million in another 10 years would have been worth $100 million. And this growth from $1 million to $100 million is what makes people billionaires. This is a company that did fantastically well. This is what people call a 100-bagger, a company that goes up in value by 10,000%. But somewhere here, when the stock market started seeing all this success and growth in international markets in Asia and Africa and Europe and everywhere, when Coca-Cola truly became international, it also became very optimistic. It was trading at like 60 times earnings in this period of time. And what happened was, again, earnings disappointments. Earnings themselves were good, but it was not as good as the stock market was forecasting. Therefore, valuation compressed. And this $100 million would have lost you half the money here. It would have only become $50 million. In fact, there's an interview a few years ago where Buffett did admit that it was a big mistake of not selling Coca-Cola when it was here. But then he had other reasons, that he has too much money and doesn't have places to put it in, therefore he kept it. And so it took a long time, a 10-year period, when these super optimistic expectations were digested and the stock went back into its growth phase as earnings were appropriately multiplied and more fairly valued by the stock market. But this is a period of not such high growth. Here in 10 years, it went from 1 million to 10 million. But in this 10 years, it only went from, went up some 3 times, not 10 times. So that's the difference. So this is an example of an outstanding investment over a 40-year period, an investment that made people like Warren Buffett billionaires. But even fantastic businesses like this, you could have bought and lost a lot of money had you been valuation insensitive. This is the real fact. Another talk of the town, Amazon. Well, we knew that 99-2000 was the period of euphoria and hyper optimism. And had you made an investment around that time, it would have taken you 10 years to get back your money, the original investment value. And somewhere along the line, you would have sold out because this investment lost some 60% of its value in the next couple of years after you made an investment somewhere here. And then it recovered. This was the period it was a dot-com hype story. This was the period the bubble burst and the after effects were felt. This was the period when it essentially went from selling books to selling everything else and opening Amazon stores with third-party merchants and so on. And this was international, and this was Amazon Web Services and all the other things that makes it $1 trillion+ company today in terms of market value. But here's an outstanding business. And there were points in time when the valuations were so egregious that had you made an investment then, it would have been very, very hard for you to make money, which is what happened in this period. Mid-2000s was actually a good time for an investment in Amazon. Then you would have captured this whole growth. That followed the business growth, by the way. So I don't mean for this webinar to be depressing and to discourage people from investing, but I was trying to showcase and bring home the point that are great companies great investments? Sometimes. So just like you cannot fly an aeroplane with just an altimeter, you also need a compass, you also need a speedometer, you also need wind pressure and so on. You need a dashboard of instruments to tell you how to fly the plane. Just like that, just focusing on the quality of a business is not enough. It's also important to focus on valuation and your downside risk, the chance that you'll permanently lose your money. So the chance that you lose your money permanently is known as permanent loss. And investing with a large margin of safety, I'll give you another case study where if you do look for an investment with a very large margin of safety, then the odds of success of that investment can be very good. Here's another real case study. 2011, that was the time when the Chinese government started cracking down heavily on property speculation in China. This was the period in time where I personally met school teachers in China who had 6 apartments on mortgages, and they were all banking on selling one for $1 million in profit, selling 2 for another $1 million in profit, and so on. So the crackdown started, and in response to the crackdown, and quite sensibly, a lot of stocks related to Chinese property started selling off. So these it makes sense, right? Mortgages are hard to come by. There's all kinds of tax and stamp duties imposed on property purchases and sales. Developers are going to find it hard to sell property, develop projects that are underway, etc. And so future earnings are under pressure as a result of all this regulation. And the stock market reacted and sent valuations down. It made sense. One of the stocks that got heavily affected was this red line, Wheelock and Company, which is a Hong Kong listed property company. Wheelock, in that 6-month period, was cut in half. Its market cap went from 70 billion to 37 billion. It was cut in half. And this was the time we took a look at the business. What the first thing we noticed, well, we knew about Wheelock. Wheelock is over 100-year-old property business in Hong Kong. And if you know anything about Wheelock and its management, they are sort of like blue blood. It's the people who manage the company are like property royalty. They have 100-year histories going back to the business community in Hong Kong, and they're very, very prominent people. Their businesses, the properties are excellent. But the Chinese exposure, this is from their 2010 annual results, and we are looking at the situation in the middle of 2011. So these were the latest figures disclosed by the company. Of 22 billion, only less than 10% was Chinese exposure. Reduction in market cap was 32 billion when the market cap fell from 69 billion to 37 billion. So 32 billion was a reduction in market cap. But at book value, Wheelock had only 2 billion or less than 2 billion in Chinese property exposure. Moreover, before this sell-off happened, it was trading at a price to book ratio of less than 1x. So maximum, this would have contributed to 2 billion of its market value, but the market cap was down 32 billion. So we were interested. There's something interesting here. Essentially, the stock market had written off Wheelock's Chinese property assets by 16 times what it was previously valued at, in response to the property crackdown by the Chinese government. We thought something was going on, so we took a look. So suppose I had all the money in the world and I went off and bought all the shares in Wheelock, and I paid off all its debt and I pocketed the cash. It would cost me 37 billion to buy all the shares. It would cost me 65 something billion to pay off all the debt, and I would pocket 27 billion. So you add this up, 37 plus 65 minus 27, you'd get a figure like 80 billion something. But Wheelock had a 50.2% stake in another listed company, and this was liquid and separately valued in the stock market. And had I sold off Wheelock's shares, which was the 50% of Wharf, I would get another 46 billion. So net, I would be paying out 29 something billion for all of Wheelock's non-properties. Well, I'd pay 29 billion for all of Wheelock's properties, excluding what it had ownership of Wharf, after paying off all the debtors and pocketing all the cash. So what were these properties that I'm paying 29 billion for? Well, their main investment properties were in Hong Kong and Singapore. There were these 3 buildings, which together was worth almost 1 million square foot of space. And these were super prime class A properties. So to give you a perspective, this would be like the MetLife building in New York, or St. Christopher Square in London, or building in the middle of Bay Street in Toronto. These were super prime properties, and they were all grade A, 95% occupied, and they were running at the best possible rents in the market. So I was paying 29 billion Hong Kong dollars to get about 1 million square foot of property. That works out to 34,000 Hong Kong dollars per square foot. Here's the insight. If I actually wanted to go and buy this office in this building here, or buy a mall or a retail outlet here, or a piece of this building somewhere, it would cost me in the physical world more than 100,000 Hong Kong dollars per square foot. And this was easily verifiable. You can go to a bank and say, hey, I want to buy this office here. What will I pay? What is the valuation at which you'll give me a mortgage? And you'll easily find out it was at least $100,000. You can look at the property transactions of the building next door, and you will find that similar quality right next door, the transactions were at more than 100,000 per square foot. So in the physical world, it would cost me at least $100,000 Hong Kong to buy a square foot of space in any of these buildings. But in the stock market, the very same properties are being valued at a 65% discount. That is a great bargain. So can you imagine in this scenario, buying property at this valuation, prime property, grade A, 95% occupied, and commanding very high rental rates, where there were people standing up in a queue to rent these properties from each other, should the lease come due and not renew. Can you imagine a situation where you had, let's say, $100,000 and you buy this stock and wait for the panic to subside? Do you see anything China here? No. Do you see development property here? No. These were prime, occupied, cash generating properties that was trading at a 65% discount in the stock market versus the real world at the same time. So this is an example of a high margin of safety. But this was not the only thing. Wheelock had a number of projects that they were in partnership with in Hong Kong, in Singapore, and some in China, where they had less than 50% ownership. And these added up to something like 16 million square feet. And essentially, after I paid $34,000 for its prime occupied cash generating properties, I was getting all of this for free. So even if you put a very big haircut and you say, hey, they're joint ventures and whatever, so it's not 16 million that Wheelock owns, but let's say let's for argument's sake say it's 5 million square feet. 5 million square feet is like 15 of these buildings coming to you for free. That is the amount of space that you're getting for nothing after you paid 34,000 for properties here. That is a case of a very high margin of safety. So what happened? Well, we were buying somewhere here heavily. And after the market calmed down and they realized, hey, Wheelock is not China. It has no development property exposure directly. Its main assets and most of its earnings and cash flows are coming from investment properties, which is owned by them, which is rented out by them, and it's got nothing to do with selling, an apartment off plan in Shanghai. The stock market woke up and they figured out, hey, the stock is too cheap, we mispriced it, and the stock doubled in 1 year. We bought somewhere here at around $20, and within a year it was worth 2x, about $40. And we sold a little after this, about a year later. And that was a mistake. The stock actually went up to something like $60. We were basically we needed the money to invest in something else, and this was one source of capital for us. But on its own, selling this was a mistake. But you can see when you invest with a very high margin of safety, the chances you'll permanently lose money and end up here is very, very small. The chance something like this will happen is pretty high. That was the case in 2011. And, people say, hey, why do you present examples from ancient history? Well, I wrote an article. This is a screenshot of a LinkedIn article of an investment we made in 2020, which is now worth 3x or more of what we paid for. It's a very well-known company, Dell Computers, Dell Technologies, and it was a case of a completely misunderstood investment situation. So, if you look me up on LinkedIn, you'll see this article and you'll see the preceding article that we wrote in 2020, which was published in Barron's, and you can run the numbers yourself and you'll see what our insight was, how we valued it, where the margin of safety was, and therefore, eventually, 1 year later, the investment result was excellent. And all of this was sort of foreseeable, not in exactly the same way. And I couldn't have told you it would be worth $50 would be worth $170 today, exactly in 8 months. But we knew something like this would happen because the margin of safety was extremely, extremely high. So I won't get into too much of that, and I will leave you to refer to the article and get a better insight. With that, I will summarize and say, first, if you find a good business, which we call a compounder, high ROE, which is reinvesting back into the business as it sees growth in front of it, and these reinvestments are also profitable and high incremental ROE, and this manifesting themselves as earnings, revenue growth, and earnings growth, and that earnings, accounting earnings, gets converted into cash and the quality of earnings are high, this is a compounder. Go back to my previous webinar and get a better idea if you like. The margin of safety refers to what is your downside risk. How much will you lose permanently if you overpaid? And you can't get this from a screenshot or a ratio. You'll have to look into the business to get an idea of what a business owner thinks a business is worth, and what a reproduction value of a business is, to get an idea of what your downside risk is, what your margin of safety is. When you combine these two, you get an exceptional investment. Those are the examples. Cisco before 98, Wheelock in 2011, Dell in 2020. These were all great businesses, which were also great investments. So with that, I'd like to say that, the work we do is every day we dig deep into companies, and even when the stock markets are at an all-time high, we don't invest in the stock market, we invest in specific situations, and we are still finding such outstanding investments. If you look hard enough, you'll find there are 36,000 listed companies in the world. I'd like to conclude by wishing you all a very successful investing future, and I'll stop at this point and take some questions.
Anand, thank you very much. Fascinating presentation as always. There are no questions to speak of at this stage. I've just asked the audience if they'd like to input the questions into the GoToWebinar chat panel. If you have questions for Anand, now's the time to put them in. And as people might be typing them in, I just want to point out that in the handouts section of the GoToWebinar pane there, you can access a copy of today's presentation from Anand and download that onto your computer for anytime reading. And once again, there is a recording coming to you later on today, a couple of hours after the event ends. Look out for that in your inbox. Question from Pedro Enrique. Anand, do you see good investment in China S&P 500 companies that are valued low?
Anywhere in the world, valuation being high or low doesn't necessarily mean it's a good or bad investment. In fact, I've even written an article about that also on LinkedIn. So the short answer is, just because the valuation is low doesn't mean that it's a good investment. You could have a valuation that is low because the business is dying, or it has a future which is a lot worse than its past, and the stock market recognizes that. So just looking at valuation alone doesn't tell you the picture. You have to basically dig deep into the company's business and think as if you are the owner. You bought this business with all your family's money and you're going to have it for the next 50 years. Is this a good place to put your money? And will you live with this business for 50 years and not repent it, not be, disappointed or worse? If you come up with an answer where you say, this is a okay or a great business, and I'm getting a cheap valuation, something is not being priced in. Maybe it's future growth, maybe it's a rebound in profitability, maybe it's a change structural thing in the market that it hasn't been widely recognized, or maybe it's just that there were irrational sellers, like in the case of Wheelock in 2011. There were irrational sellers. There was no reason a Hong Kong building and a Singapore building that was tenanted should be selling off so badly because there was a property clampdown in China for developers. Wheelock had nothing to do with development property in Hong Kong, in China. So when you find a disconnect, that's where you find opportunities. Just valuation alone doesn't tell you anything.
And
so
on page 44, Luke's asking the question, what do you mean by the high watermark?
Page 44.
Yep.
Oh, high watermark, you see this red line is basically the highest value of the stock until that point in time. So that was the highest value of the stock over here from the time the stock chart. It gives you an idea of if you buy at the worst possible time and sell at the worst possible time, how much money do you lose? The high watermark is the highest value of the stock seen until that day.
Okay, thank you. George asks a very open-ended question, pointing out that Tesla is at a 680 times price to earnings ratio. What is a reasonable PE ratio?
Again, just like a cheap valuation doesn't mean it's a good investment, an expensive valuation also doesn't mean it's a bad investment. There was the same chart that I showed you that if you go back to Cisco before 1998, this was 98. The valuation in this period coming up from 1990 to 1998 was always quite expensive. It was 25 to 50 times earnings. That by stock market averages was high valuations. But had you bought in this period here, you would have seen your wealth grow, and maybe you would have experienced this crash, or maybe here, or maybe here. Somewhere here you would have sold, but your money would have still multiplied enormously. So just because the valuation is expensive doesn't mean it's a bad investment. Again, I go back to the same thing. You'd have to ask yourself the question, do I understand the business well enough to form an opinion on it? Can I see what it might look like 10 years later? And if I were to buy it with all my money and it gets delisted from the stock market for the next 20 years, will I sleep well at night? If the answer to those three questions are yes, and it has to do with underlying knowledge of the underlying business, and you get that by digging deep, that's when you find a good investment. Multiples have nothing to do with it. It's only a reflection in the mirror.
Switching gears a bit, this is with Alibaba and Tencent in mind as examples. How do you account for regulation uncertainty in Chinese markets?
Well, you have regulation uncertainty in other markets too. If you had bought Bayer, which is a German company, and they got hit by the Monsanto lawsuit and their stock got decimated, it dropped like 70% when the lawsuits became class action in the US, the Monsanto glyphosate illness-causing lawsuits, cancer-causing lawsuits. It was an existential threat to the business and it decimated itself. The stock was a terrible investment. So in China, Alibaba, Tencent, yeah, you have regulation risk. Well, when you say, what is my margin of safety? Essentially, the idea of margin of safety is that you buy only at a valuation which is far below or below, substantially below, what you think is a carefully appraised valuation of the business. So that's why I keep saying, another way of saying it is, if you have to put all your family's money in this business and buy it over, and it's the only business you could own for the next 50 years, what would you think you'd pay for it? You think about that quite deeply. And then you only buy it when you find a market price substantially below that number in your head. When you do that, it gives you a safety margin when, bad luck or unforeseen events like Alibaba, or mistakes that you made come to play out, you still don't permanently lose money. The concept of margin of safety is very simple. It came with the Romans. The Romans would build bridges for the armies to go from one place to another. And the engineer would be asked to stand under the bridge before the army crossed over the first time. If the bridge was not strong enough, it would collapse and fall on his head and he would die. So what happened? The engineer would build a bridge which is substantially stronger than what he's been asked to build because he didn't want to die. So what I'm pointing out is you're looking for robustness. How many things can go wrong and still me not lose money is the question you have to ask yourself before you make an investment. If you price everything for perfection and you pray at the top, and then reality that unfolds has to be so great and perfect, only then your investment will grow in value, then that is a bad investment. So short answer, there are unforeseen things in every investment, not just Chinese. But when you consider margin of safety, you have to account that such things can happen and then pay a price which is able to withstand shocks from such things. Had you paid a very high price for Credit Suisse, today you'd be suffering because of Greensill and Archegos scandals. But had you bought it at a bargain price around 2011, 2012, or 2013, after the aftermath of the 2008 crisis, these were all very cheap, and you held on. Well, even the crises that you did see would still not harm your wealth. It would have taken you down a notch or two, but you wouldn't have, suffered permanent losses. You would have suffered maybe a loss in your unrealized profits, which is okay. Don't lose money. Rule number one, this is what it means. Don't experience permanent losses. And you can only do that by investing with a margin of safety.
And then a couple of people asking about past performance at GFM. Probably best if they just contact you directly on the information on the screen, I think, rather than trying to answer that question here.
Yes, we have past performance. It takes me a second to pull it up and show it to people, but since we are regulated, licensed, and we're investment managers, we can't really go around, publicly displaying past performance and stuff related to this. So just to avoid trouble, I would request that whoever is interested, please get in touch, LinkedIn, email, WhatsApp, whatever. And I'll be very happy to share that information with you. Of course, any potential client of ours first sees a presentation with past performance, with some examples of how we think our process, case studies, etc., before they even consider becoming a client. But you're welcome to do so. There's no pressure to becoming a client. We will not pressure you at all. And you're welcome to ask for the information, look at it, and form your own opinions on whether or not we are good investment managers.
Thank you, Anand. A couple more questions. What do you think, this is from Yisun, what do you think will be the next profitable sector for the next 5 years? What do you think will be the next profitable sector over the coming 5 years?
Well, one of the lessons I've learned is I don't want to look at sectors, or I don't want to look at countries, or I don't want to go top down ever. The way we look at, I mean, I don't want to invest in the markets or sectors of the market or subsets of the market because the future is bright. I mean, again, there's no genius required to know that a whole pile of tech companies that are SaaS-like are going to be very successful in the future. But just because a sector or a space is good, anything electric vehicles, you know, there are definitely going to be more electric cars 10 years later than there are today. 20 years later, that number will be even higher. Alternative energy, green energy, all these kinds of sectors have a very strong tailwind and a bright future for a lot of these businesses. This is what you find when you say sectors. But just like I pointed out with the Cisco example, just because it's a growing sector or a business whose future looks brighter and bigger than it is today does not mean it's a good investment either. So the way we always do it is, yeah, we do look at, you know, what might be growing, and we've looked at all sorts of businesses in the EV space, for example. But I'm sorry to say, but I find more short candidates than long investments in the EV space at the moment. Well, I'll give you just one example. Continental AG, a German listed company, is a tier 1 OEM supplier. And, you know, if they were to stop operations, Mercedes, BMW, Volkswagen, and a whole pile of others will be heavily disrupted. So they are the cog in the wheel that makes the wheel go around. EV is an existential threat to Continental, and unless they completely change the business and the way they run the business, they are going to be, you know, fighting for survival. Why? A normal internal combustion vehicle has something like 20,000 moving parts in its engine. And a lot of these parts are sold and supplied and assembled, and a lot of labor, etc., is put in. And a lot of that goes to Continental. 20,000 moving parts. An EV has hardly even 20 moving parts in the engine. It's just a battery and a bunch of wheels. So what is Continental going to do 10 years later when EV is going to be, let's say, 50% of the passenger car fleet globally? Where is it going to replace these lost revenues? So you're going to see, I say, a lot of short selling candidates, or you'll find companies priced to the sky. You know, EV, you know, let's say we say the future is bright, but then you have a Tesla earlier this year that was trading at a market cap of higher than all the other auto companies combined: Toyota, Volkswagen, Mercedes, BMW, a whole pile of others. It was at a market cap higher than all of these guys combined, and it was trading at something like 1,600 times earnings multiple, price to earnings of 1,600 times. So if earnings don't grow, it will take you 1,600 years to get your money back. If earnings grow 100 times, then it'll take you 15, 16 years to get your money back. For earnings to grow 100 times, you'll have to see lots of passenger cars on Mars. So essentially, that's another Cisco in the making. So short answer is, looking at sectors will give you, you know, exciting new ideas, but not necessarily good investments. You have to look beyond the sector and into the business and into the future profitability and growth of the business. So the ROE and the earning quality and the earning growth, again, I refer you back to my earlier presentation where we unpack these things, is one side of the equation. The other side of the equation is margin of safety. When you find a good business with a bright future at a high margin of safety, you find an exceptional investment. The absolute wrong way of looking at it is to screen them by price to earnings ratios or revenue growth or earnings growth, or take 100 companies and you do all this kind of screens. You get some short list and you say, hey, I put 50 of these in my portfolio, I'm going to have a good portfolio. Completely wrong. If that was the case, my life would be so easy, and everybody would have exceptional investing results. But the reality.
And thank you very much. That's a great note to finish this wonderful presentation on. Thank you again for getting up or staying up in the middle of the night in Hong Kong to share your thoughts with the audience. We definitely appreciate it. Some great questions there from the audience, and I'll forward any outstanding ones to you later this afternoon. And I'd like to thank you again, thank the audience, and I'll let you sign off, Anand.
Thank you for your time. I really hope this was useful, insightful, and helpful for your future investing thinking and thought processes. We'd love to hear from you. Feel free to get in touch, drop an email, send us a LinkedIn. And there's no pressure for anybody to become a client. You're welcome to just say hello and be in touch. With that, I will sign off and look forward to seeing you sometime in the future. Bye-bye.
Thanks, Anand. Good night, everybody. Bye-bye.